Good evening, everyone. At Trading Owl, our vision is not only to trade together but also to learn in the process. Now, today we are going to see how to analyze the balance sheet of banks and the quarterly numbers. So, a bank's balance sheet can be defined as part of a bank's financial statement, which represent the financial position, that is the financial health of banking entity at a certain point of time, usually at the end of the accounting period or the quarterly ones. Now, banks do not operate as the regular company does. Hence, the bank's balance sheet is different from other financial institutions. So, before we see how the asset and liabilities are treated in the balance sheet of the bank, let's understand how banks work. Banks take in deposits from consumers and businesses and pay interest on some of the accounts. In turn, banks take the deposits and either invest those funds in securities or lend to companies and to consumers. Since banks receive interest on their loans, their profits are derived from the spread between the rate they pay for the deposit and the rate they earn or receive from borrowers. So banks also earn interest income from investing their cash in short-term government securities, and that is why the bond yield is very, very important for banks, because they invest partly their income in the government securities. Now see how we treat the assets for banks. Assets accordingly in the banking world are usually money granted by a bank, a loan or other means. The liabilities in case of banks, now where does the money come into the bank? Mostly it is the money of savers and depositors, etc. Therefore, the amount deposited by the saver into the bank is the liability for the banks, because banks have to return that money to the depositors. The capital equity is bank's own resources that consist of capital contributed by shareholders and the retained earnings of the banks. Now, in case of banks, we don't have to go through those 30-40 pages of their balance sheet. We just have to pay attention to those important metrics to analyze how healthy and how profitable the bank is. So the first is CAR, that is capital adequacy ratio. It is the measure of a bank's available capital divided by the loan assessed in terms of their risk given by the bank. CAR is used to protect depositors and promote the stability and efficiency of financial system. It also helps measure the financial strength or the ability of the financial institution to meet its obligation by using its assets and capital. The higher the CAR, the better the bank is capitalized. So in India, as per the RBI norms, the Indian commercial banks are required to maintain a CAR of 9%, while Indian public sector banks are emphasized to maintain a CAR of 12%. Now, to understand this more clearly, suppose the CAR of XYZ bank stands at minus 2.8% during certain quarter. This shows that XYZ bank has no capital to be absorbed as losses from bad loans. So that is why this capital adequacy ratio is very, very important for the investors to consider to gauge the profitability of the bank. Now the second is the gross and net non-performing assets. So now non-performing assets indicate how much of bank's loan book is in danger of not being repaid. A loan turns non-performing if the interest or the installment of the principal amount is not received for a period of 90 days. Yes, the period is 3 months. And NPAs are further categorized as gross NPA and the net NPA. Now, what is gross NPA? Gross NPA includes both the principal and the interest aspect of the loan, whereas net NPA is calculated mainly by subtracting the provision made by the bank from the gross NPA. Now, the next ratio is the provision coverage ratio. We must have heard about this ratio many times, and it's a very, very pertinent ratio in terms of gauging the performance. In banking, it is a fact that some portion of loans will always turn bad, and therefore banks make provision for such bad loans by setting aside funds to be prescribed a percentage of their bad loans. Now, to understand it more properly, let me just take an example. If the PCR is 70% for a particular category of bad loans, banks have set aside funds equivalent to 70% of those bad assets out of their profit. So a high PCR means that most of the asset quality issues have been taken care of. Like in case of HDFC Bank, the PCR was somewhere in between 70 to 75, and in case of ICICI Bank, the PCR was extremely good. It was 80%. So that means the bank has the provision to take care of its bad loans. And we remember in 2009, financial year 2019, when Yes Bank plunged, the PCR of the Yes Bank was somewhere around 43%. So that just kind of shows that, the bank was in trouble. So this is a very, very important ratio that, all the investors and traders should pay attention to whenever the quarterly results are out. Now, the fourth one is return on asset. In the balance sheet of banks, loan given out to borrowers are asset, whereas the depositor money is a liability. The return on asset depicts how profitable the bank is relative to its total asset, and it is calculated by dividing the net profit by total asset. A high ROA relative to other banks can be on account of sometimes some banks have higher ROA. So the reason could be they have other substantial income. Aggressive lending practices also is one of the reasons for higher ROA. Operational efficiency, and of course other factor which influences the ROA of the bank. Now, these are the three other ratios which I pay a lot of importance to, and it's enough for the investors to know how healthy the bank is. The other one is CASA ratio. It stands for current account, saving account. CASA is the percent of deposit held by banks in current and saving account. Banks pay low interest on such accounts, and a high CASA ratio is very, very positive and good for the bank. And that is why most of the banks would just run after the current account and the saving account deposits, because it's highly profitable and positive for the bank, as it is able to reduce the total borrowing rate. The other one is the net interest margin. As the name suggests, it is the difference between the interest income generated from borrowers and the amount of interest paid to depositors relative to total deposits. It's a profitability ratio and similar to the gross margin of a normal company. The banks like HDFC Bank, ICICI Bank, SBI, Bank of Baroda, they are able to raise capital at a low cost because they have one of the best net interest margin in the banking sectors. So for them, raising capital is not difficult because their net interest margin is highly wholesome. Now, the cost to income. It is again a very, very important ratio to determine how efficiently a bank is being run. Cost to income is calculated by dividing operating expenses by the bank's operating income. That is, what is the bank operating income, that is interest income plus the other income. And there is, now how do you just read cost to income? There's an inverse relation between the cost to income and the bank's profitability. So lower the cost to income ratio is, the better the profitability is. For example, HDFC Bank, ICICI Bank, the cost to income ratios have consistently decreased over the last few years compared to PSU banks. Now, based on this metrics, I have analyzed the result of HDFC and ICICI Bank result. So let's see. ICICI Bank, the loan growth is about 15 to 20%. Retail growth is 22.7%. Corporate loan growth is 21.2%, which is like highly, lucrative for the bank. NIM has increased for 4.65 to 4.90%. Now ICICI looks more like a retail bank because 54.7% of the total loan book is retail and the rest is 45% is the wholesale book. The deposit growth rate is about 10%, whereas the loan growth is 15 to 20%. So I guess with the numbers that ICICI Bank has released, the only thing that disappointed me is the deposit growth rate. The deposit growth rate should always be higher than the loan growth rate for a good profitability. The capital adequacy ratio is 18.34%, which is higher than the average of 17.60. So this is an extremely good number by ICICI Bank. The bank is recapitalized to capture future credit growth. Asset quality, slippages have gone down to 4297 crore. Gross NPA declined to 2.81%. PCR is at a strong 82%. It is like higher than the average PCR maintained by the banks in the industry. NPA is no longer a problem for ICICI Bank because PCR is in a very, very healthy range. Now, for me, I haven't looked anything beyond these numbers to kind of, come to a conclusion that how good the result is. You just look at these numbers and you are like sorted that, okay, this bank is healthy and it is, from the fundamental point of view, it is very good to invest in. Now, the second is HDFC Bank. In HDFC Bank, advances growth is again, the loan growth is between 15 to 20%. The advance is growing at the rate of 16.9%. Retail growth is 20.8%. Corporate growth is 12.6%. And deposit grew at 19%. The deposit growth here is at about 9 to 10%. HDFC Bank grew deposit by 19% and the term deposit grew at 29.6%. So HDFC Bank added a staggering 3.3 lakh crore of deposit over the last 1 year. And if you look at the net interest margin, this time it has improved to 4.1%, which was a concern for few quarters on the back of a rising retail growth. The capital adequacy ratio is again 19.3%, which is very good. The average of the industry is 16.4% and HDFC Bank could just, maintain it above the average of the industry. PCR remains extremely strong, but little less than ICICI Bank. It is at 73.2% and GNP fell to 1.12% from 1.23%. Now, based on those metrics, I have analyzed these two banks and let's see what are my conclusions. HDFC Bank and ICICI Bank asset quality is stabilizing. The loan growth is stable in both the banks. Bank is strongly capitalized to take advantage of future growth. This is what PCR ratio signifies. ICICI Bank deposit growth needs to pick up compared to HDFC Bank. Why I am saying this, I'll just here elaborate little bit. we have to understand the primary business of a bank is managing the spread between deposit that it pays consumers and the rate it receives from their loan. In other words, when the interest that the bank earns from loan is greater than the interest it pays on deposit, it generates income from that interest rate spread. And that is why the size of the spread is a major determinant of the profit generated by a bank. And that is why, the most of the banks prefer the deposit rate to be higher than or the analysts prefer the deposit rate to be higher than the loan growth rate. Now, both these banks, based on these metrics, what I suggested in this presentation, are very strong in terms of asset quality, loan growth, and both banks are strongly capitalized to take advantage of future growth. So that's it. I think you just need to know these metrics to gauge the performance of the banks and to just check the profitability. You don't need to look anything beyond and just go through those slew of numbers in the balance sheet. I think this would be enough for you to just make a very pertinent conclusion about the bank's performance and the quarterly numbers. Thank you so much.